You've been lied to. For years, the retail trading industry has pushed a very specific, very profitable myth that price action is king. That if you just memorize your candlestick patterns, your engulfing bars, your dojis, your head and shoulders, you'll be able to print money in the US markets. But if that were true, why do 90% of retail traders still lose? Look at this chart. If you trade pure price action, this is a textbook long. It's breaking a major resistance level. You buy the breakout, put your stop just below the line, and wait for the profit. And then you get crushed. You get stopped out. And to add insult to injury, 5 minutes later, the market reverses and goes exactly where you thought it would go, but without you. Welcome to the liquidity hunt. My name is Ben, and over the last couple of decades in the financial markets, I've seen thousands of traders blow up their accounts because they were trading a one-dimensional chart. Today, we are fixing that. In this masterclass, I'm going to show you why price alone is a trap designed by institutions to take your money. More importantly, I'm going to show you the missing dimension, volume. We're going to cover the exact volume signatures that differentiate a false breakout from a massive, multi-week runner. Grab a notepad. Let's get to work. To understand why volume is the holy grail of trading, let me tell you about two guys I used to trade alongside early in my career. Let's call them Mark and David. Mark was a price action purist. His charts looked like modern art, dozens of trend lines, Fibonacci retracements, and moving average crossovers. If a stock broke a trend line, Mark bought. Period. David, on the other hand, kept his charts completely naked, except for one thing at the bottom of his screen. The volume histogram. When the market would gap up on Monday morning, Mark would rush in, terrified of missing the move. David would sit on his hands. He'd wait, because David understood a fundamental truth about the market. Price is just advertising. Volume is the actual transaction. Think about it like real estate. If you see a house listed for $5 million, does that mean the house is worth $5 million? No. That's just the asking price. That's the advertisement. But if you find out that 3 different buyers just submitted cash offers for $5 million, now you have a $5 million house. The transactions validate the price. In the stock market, volume is the transaction. If price is moving up but volume is dead, the market is simply floating on a lack of supply. It's an empty room, and the moment a big player steps in to sell, that floor will collapse. To stop getting chopped up by false moves, you need to understand the core engine of the market, the law of effort versus result. This was pioneered by Richard Wyckoff over 100 years ago, and it is just as relevant today on the NASDAQ as it was back then. Here is the golden rule. Volume represents effort. Price movement represents the result. When the market is healthy, effort and result are in harmony. If you have massive volume, huge effort, you should see a massive price candle, huge result. That tells you institutions are in the driver's seat, pushing the stock in a definitive direction. But what happens when effort and result diverge? That is where the magic happens. That is where you find your edge. Let's look at a real-world example using NVDA. Notice this period of consolidation. The stock is chopping sideways. Retail traders are getting bored. The Bollinger Bands are squeezing incredibly tight. A price action trader is just waiting for a candle to pop out of the top band. But look at the bottom of the screen. Look at the volume. Right here, we have a massive spike in volume on a down day. This is massive effort. Millions of shares are changing hands. But look at the result. The price didn't crash. The candle is tiny. It closed right in the middle of its range. If there was so much selling pressure, why didn't the price drop? Because a larger entity was sitting right there, absorbing every single share the panicked retail traders were selling. The smart money was loading the boat. Massive effort, no downside result. That is a bullish divergence. 3 days later, the stock breaks out. And look at the volume on the breakout candle. It dwarfs the previous week's. That isn't a retail trader buying 10 shares on Robinhood. That is institutional accumulation. That is a breakout you can trust.
Now that we understand the mechanics, let's get tactical. I am going to give you 3 specific volume signatures that you can start looking for in your scanners tomorrow morning. Signature 1, the exhaustion climax. Trends don't die quietly. They die in a fiery explosion of emotion. When a stock has been selling off for weeks, retail traders eventually hit their breaking point. They capitulate. They sell just to stop the pain. This creates a massive, violent drop in price.
Look at this chart. The stock is bleeding out. Then, on a random Tuesday, we get a massive red candle. It gaps down, it flushes hard, it looks like the end of the world. But look at the volume. It is the highest volume we've seen in 6 months. This is the volume climax.
Who is buying all those shares? For every seller, there has to be a buyer. If retail is panic selling in record numbers, the institutions are the ones happily buying at a massive discount. When you see a multi-month high in volume on an extreme down candle, and the very next day the price refuses to go lower, you have just found a market bottom.
Signature 2, the low volume pullback, the no supply test. This is the bread and butter of swing trading. You find a stock that just had a massive high volume breakout. You miss the initial move. Do you chase it? Never. You wait for the pullback. But how do you know if the pullback is a healthy retracement or the start of a massive reversal?
You watch the volume. In a healthy uptrend, the big money institutions have already taken their positions. When the stock pulls back, they aren't selling. The only people selling are short-term flippers taking quick profits. Because the big players aren't selling, the volume dries up. Look at these 3 red days. The price is dropping, but the volume is shrinking every single day. We call this no supply. The market is testing the downside and finding zero selling pressure. The moment you see a green candle push up with an uptick in volume, that is your entry. Your stop goes right below the low of the pullback. It is the highest probability trade in the market.
Signature 3, the fake out, the bull trap. Now let's go back to the scenario we started this video with. The trap. How do you avoid buying the top? The stock approaches a major resistance level. Everyone is watching this line. The market opens and the stock pushes right through the line. The breakout is happening, but look at the volume bar.
It's anemic. It's pathetic. There is no institutional participation here. What is happening under the hood is that the market makers know retail traders have their buy stop orders sitting right above that resistance line. They let the price drift up to trigger those orders. Retail buys thinking it's a breakout. The market makers sell their inventory into that retail buying. Once the orders are filled, there is no more buying pressure. The floor drops out, the stock reverses, and retail is left holding the bag. Never trust a breakout that is not supported by above average volume.
Information is useless without execution. How do we actually build a system around this? If you are using scanners to build your watch lists, and you should be, you need to stop scanning just for moving average crossovers or RSI levels. You need to start scanning for relative volume. Here is the exact logic I use when looking for U.S. equities to trade.
First, I want to see a stock in a tight consolidation. I want the Bollinger Band squeezing. This tells me energy is being stored. Second, I want to see volume drying up during that consolidation zone. I want to see days where the volume is 50% below the 20-day moving average of volume. That confirms that supply has vanished from the market. Third, I set a price alert just above the consolidation zone. When that alert triggers, I don't buy blindly.
I look at the time of day and the volume pace. If it's 10 a.m. Eastern Time and the stock has already traded its entire average daily volume in the first 30 minutes, I am slamming the buy button. That is institutional urgency. But if it breaks out at 1 p.m. during the lunchtime lull on practically zero volume, I ignore it. It's a trap.
When you start filtering your setups through the lens of volume, your win rate won't just improve, your mental capital will skyrocket. Because when you are in a trade backed by institutional volume, you don't panic when the stock ticks down a few cents. You know the big money is defending your level.
Trading without volume is like trying to drive a car blindfolded by only listening to the GPS. Sure, you might know the general direction, but you have no idea if there's a brick wall right in front of you. Price is the result. Volume is the truth. Start looking at your charts differently today. Go back and look at your last 10 losing trades. I guarantee you, if you look at the volume on those entries, the market was screaming at you that the move was fake. You just didn't speak the language yet.
Now you do. If this masterclass changed the way you look at the markets, hit the like button so the algorithm knows to push this real education to other traders who are stuck in the price action trap. Subscribe to the channel because next week I'm breaking down how to manage your risk and position sizing once you actually catch one of these high volume runners. Until then, protect your capital, trust the volume, and I'll see you in the markets.